The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044. This is the Futures Hour. Here's your host, Larry Pesavento.
Hi, everyone. Basil Chapman sitting in for Larry, and we're looking at a very interesting market here. Why? Because I've posted into the den. That's what Larry likes to say. I've posted into the den a chart of the continuous contract of wheat continuous contract, which is really interesting because this is leg B in the weekly chart. Now, for those of you who are not used to my Chapman wave methodology, basically I look for the most identifiable lowest low bar and merely count each successively higher peak. If certain conditions are met, and you get to leg B in a certain way, sometimes it's A, sometimes it's even C. But if it's the second highest peak and it happens quite quickly, as it has in the weekly chart, and the technicals are confirming the move, it suggests very strongly that the left side highs and previous peaks could become targets to the upside. And if that's the case, there's a good chance that this could go from a buy signal. We'll know by Friday, by tomorrow at 4 o'clock, whether this really constitutes a good buy signal. Certainly there's huge volume coming in, or whether or not it's just another retracement failure mode as we've gone to B before in the monthly charts and a C minus in the weekly charts that just constitutes a single leg or two legs up and failure pattern. No. This is suggesting very strongly that wheat is looking quite good and that there's a good chance you're going to get at least a leg C and maybe even a peak C and then peak D going all the way into November, maybe December. So far, wheat is acting very well. But there's a pattern that I want to talk about. It's what I call the Chapman wave flat base. Well, it's based on the instant restart. For those of you who know my technique, the instant restart, in my CD introducing the Chapman wave methodology, that is chapter, instant restart is chapter 19, is it? I think it's, chapter 19 starts at about slide 346, and it discusses what happens when you get to the fourth highest peak from the low bar buy signal, and it goes peak A, peak B. Remember, each successively higher peak gets labeled alphabetically with uppercase letters and the upside, lowercase on the downside. It goes to C, and then it goes to a D. And at D, other things can happen. But if there's just merely within 2 to 3 bars, there isn't a breakdown at D, but you go to a higher high, a parallel wave count can occur that goes E/A. It's a very positive action that goes to at least 2 higher peaks minimum. So it's a very positive action if there's a decent breakout. And what happens is it could either recycle and then become a brand new peak A, B, C, D. At that point, you get a whipsaw to the downside if a certain pattern happens, and that's in the Chapman wave flat base restart. And that's what is a possibility here, and it suggests, let me just draw this in for you. Oh, I just jumped into something very heavy. Instead of just treating this just nice and easy like an analysis lesson instead of a lesson in different techniques. But I do want to say this because it's very important in the structure that's being formed right now. If this is a brand new A in the daily, it suggests that there should be higher peaks going all the way in. At a minimum, it should take you to the end of next week or the beginning of the following week before it gets to a D. If that's the case, you're going much higher, and that would suggest even that the left side peak, that's what I was talking about earlier on in wheat, can go to the high that was made the week of the 8th of August at 587 round number high. It's trading at 553.5 right now. So this is going to be very important. Why? Because the other pattern that I'm talking about suggests that the price will be under 507 and a quarter, the low of the 20th of October, at some point in November, if this is a Chapman wave flat base restart. And we won't know for a little while because of the structure of this particular move now in 3 days. It's just had a spectacular move going from the 511 area all the way to today's high of 556. That is huge in wheat. You don't often see spirals like this to the upside with such big candles in such a short period of time. So I thought I'd bring that up. And now I wanted to also do, I haven't looked at it, I'm going to do it now. This is the corn. So corn has done something else. That is said, if you're using wheat as an example, then the characteristics we were looking at are not quite the same because A to B, this is really interesting. I never expected that to see this in the commodities. This to be absolutely safe, I need to call it F/C. So this could be a brand new, I'm almost sure it's a brand new leg C in the corn contract. That is so interesting. Look at this. Corn. The stochastic is at 75% coming back after being fabulously strong, then pulling back in that slide from the doji high E of the 30th of October, 381 round number high, and then it comes down to 359 round number low on the 5th of November, and now it's A, B, and this is almost certainly a leg C. How many, what am I doing there? Edit, get rid of that. Okay, so, but the monthly chart is still terrible, but it is trying to come off the lows. The weekly chart is in leg B, very much like the soybeans, and that is very important. So now what I want to jump to is I want to jump into the bonds. I didn't do that on my show earlier, but I should have done it, and I didn't. This is a leg D with there's such a huge probability that it'll be a peak D at the end of November if there isn't a high above in the continuous contract above the 137 and 27/32 high of last month. Everything about it says that within the context of channels. Oh, I didn't do that today. I had a whole I decided yesterday to follow up on all the channel talk I was doing for the whole week, and I forgot to do that. Well, it's too late now, but I'll do maybe in this show. Look, this should be a green line. This is saying that bonds have had a very nice steady move, but it's just a nice steady move, and it just happens it's one of the smallest moves to the upside from the low of 123, just over 123, to the high of 137. So that's 14 points. Other moves to ABCD have been huge before, and it went to an all-time high. So in the context of chart patterns that I always look at in the Chapman wave, we've got to be aware that there is a potential double top forming in the bond chart, the monthly bond chart at leg D. It does sometimes recycle higher to an E and even an F and a G, but I'm treating this with great respect because of the pullback that occurred. The stochastics at 82% and good. The MACD is okay. It is positive, but it isn't very strong. It's steadily up, but not yet superb. And what I'm looking at is that the inside track, lower rising, small up channel at the bottom end of the major up channel that goes on for a long, long time, many years. This is a containment area, and it says that at any point in the next month or two, a close below 127 in the continuous contract. I'll just give you that figure as it relates to the Z to the December contract. It's not so good to do that. Let me give you, yeah, I'll do that, but a close below 130 in the December contract, and it's trading at 141. Well, we don't have to talk about that. That's just too far. So let's go back to this one. So in this particular instance, 141 is where we are. 137 is really the important 200 period. That big, thick black line is the 9-period moving average. If you see a close in bonds below that, it says that this chart here, let me get rid of this one here. Let me get rid of this. TLT, we'll call it. TLT. Okay. I need to close this one, and I'm going to go to something else. Close workspace. And I'm going to go to right here. This one here. You remember the weekly chart that I discussed every week? I show it to my subscribers of my opening call, and this is a chart that shows you the weekly pattern. Let me just squash it a little bit so you can see where it comes from. It comes from this cluster pattern back in June of 2007 at 54.08. 5.4 was the percentage 30-year T-bond rate, and it plunged all the way down to the most recent low. This is the white one, is the 30-year, down to somewhere in the 2.4s. It's gone lower than that. I know. Yeah, it's gone to 2.514. 2.5 into the 2.5 area. So 2.519 back in December of 2008. Right now it's at 3.08%, and it's formed. I drew this a long time ago, many weeks ago, that I said this is the pattern. That's the larger context. That purple. Let me go back to it now. That purple, it's blue, outline right there. But within it, I said there's a much smaller range, and the range was a low of 29.35 and a high somewhere around the 31 and a half area. I said that could be the range we're stuck in here, at least for now, in the T-bonds. And the 10-year T-note is at 2.35, and there as well, it's a little bit stronger, but it's kind of stuck in this range. But if there is a break to the upside and you start to see leg B, I have to respect that bonds are going to be pulling back. This is a very critical time for bonds. Over 31.33 starts leg B in the 30-year. Over 26.76 starts leg B in the 10-year T-note. And over 18.68 starts the leg B up in the 5-year. So we've got to keep that in mind. So I wanted to go through a bunch of things like that right now. This is not esoteric. This is as it relates, as I did in my show earlier. I spent a little time on the UNG natural gas and coal, and I discussed them in the context of seasonality. Well, there isn't necessarily a seasonality here to the bond charts. You can see they just. I've not yet picked out a seasonality, other than that yields have remained pretty low and should continue to remain low. But this is going to be very important. You remember I talk about wood. WOOD is the iShares Global Timber and Forestry ETF. Look how it got repelled yet again, right at the resistance. And yet, the home builders have had a very strong move, are trying to retest their most recent highs for the last year. We'll talk about that when I get back. Basil Chapman, Tiger Technician. Oops, it's Larry from the Pesavento show, and I'll be right back.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Hi, folks. Basil Chapman sitting for Larry Pesavento in the Futures Hour. And I had a couple of questions there. One is, I don't understand this. Thursday, 12:02 question. I just turned on TFNN radio and heard you say the dollar is in peak C. This is after days of saying it was in leg D and nibbling at gold? Question mark, question mark, question. I did not say that. It's right here. I said the dollar isn't at peak D. The UUP, which is the derivative, and I never go just by derivatives. I usually go by the core. UUP is at peak C. Yeah. You heard that correctly, only in the context of not the dollar, but the power shares. DB US dollar bull, that's different. That often fails to correspond exactly when it comes to the peaks. I shouldn't say often, but often enough that it's failed. I actually don't like it. Occasionally we've traded the UUP. I don't particularly like it. It's it trades close to the dollar, but somehow or other I've never been a fan of this particular instrument. No, I'm going by the dollar. The dollar itself made a D, and it's in a consolidation phase. If it breaks the lower part of the consolidation phase, that's where and when gold will start to move, and it'll be, I still consider it to be just a counter-trend rally. I hope that clears it up for you. So Dan in Baskin Ridge, in New Jersey. Dan, how are you?
Doing well, Basil. Thank you.
Good.
I had a question in, longer term, just like a longer term view. it doesn't seem like the market has provided any real good entrance for everybody that's on the sideline, and that has been for the past few years, to get into the market.
Correct.
And, I guess Tom's saying, the point of the market is to take the most amount of money for the most amount of people in the quickest amount of time possible, and that doesn't seem possible until the cash gets into the market. And it seems to, I was looking at the NASDAQ composite going back to 2000.
Yep.
We're only, 10% away from that, right?
Well, I'm going to
do... a 12% move to get to the highs of 2000.
Correct. If I go to the QQQ series, and I've quoted this. I used to quote it very successfully on the way where it was on the way down, and now it's I wouldn't say it's embarrassing because it's 14 years, but I had said that in my lifetime, when I got a sell signal on the QQQ series back in April of 2000, that was based on the weekly chart and based on the NDX 100 as well, I said that this will be a high that will never be seen again in my lifetime. My thinking was that to get to this phase, not only did you have to go down really sharply, but you had to come back, and there had to be the same kind of flurry of total fascination by the general public to be able to make those moves. But look how steadily you've gone up. Because of the way that the market has walked the 9-period exponential moving average, you can see I'm showing that big, thick black line there, which is the 9-period moving average. In the monthly chart, it's been a very steady move up. I have no problems with this particular move up. There's nothing parabolic about it. My suspicion has been for a long time, and I'll be giving a talk next week. I'll give some more information out on it a little later on. But here in the Boston area, my suspicion is that the rotational aspect, and this is what I've been discussing here, and certainly for my subscribers, that the rotational aspect into some other areas, especially heavy-duty cyclicals, could produce the next momentum move for the upside, and that would be that would allow for sectors like biotech and some of the very overbought sectors to take a big breather as other sectors take the baton. Just like in a relay, if you've ever run a relay race, you know that the passing of the baton, and I always think of the Olympic Games back a couple of decades ago, where it was the most embarrassing and most disgusting thing I've ever seen in my life, where in sport, where the baton was dropped by the United States Olympic 100 yards men's team. It should never, there's just no excuse ever to drop a baton. That's what you practice and train for. That's the big thing. But if you just grab 4 of your best people, put them together, this is what you get. However, the rotation has to be smooth. You don't want to drop the baton. And I think that the way the transition is going to work in the next week or so, we're going to find out on the next big pullback of a few percentage points just how deep it is and which sectors like a sieve are holding up well, which go right through. You want to hold on?
I would love to.
Okay, we've got Dan in Baskin Ridge, and we're talking about the NQs, the NASDAQ 100, or the QQQ Trust Series. Dow's up 51, S&P's up 1.3. I'll be right back with Dan.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com. Now, back to the Futures Hour.
Hi, folks, we're back. So we were talking about the QQQ with Dan in Basking Ridge, New Jersey, and basically what I was saying is that I never anticipated that in my lifetime I would see that the Nasdaq would come back to the 100 and what did I say it was? The QQQ series would come back to the 120.50 all-time high. It went down to 19, so it went down to $20. It's a 90% decline. So it's been such a steady move from the low back in 2002 that was made that this is very different in the sense that there's no hysteria that I see in the QQQs at this time. I see overbought, but not hysteria. However, my suspicion is that if you're looking at the IBB, and I should just mention that for some kind of clarification, in my opening call, we have constantly been long the IBB via the BIB, and it's done very nicely. In the last move, we've kind of raising the stop. We'll see what happens there. But I'm expecting that there could be a leg C to the upside in the daily. But in the meantime, the IBB has begun a move that could very well be the extension that takes it to some kind of a level that says, okay, as a sector that fund managers could get to. We've had a very sharp decline, equivalent of something like the 1929 March decline in the Dow, and then it went on to all-time highs, and then it came down for that rather extended bear market. But this could be that the biotechs are making some kind of a top here, which correlates to the incredible overspending. I was going to do this in the Boston Globe today to show it, but I decided I'll skip it because we've done so many of these reports of how the biotechs are just buying up Kendall Square and other areas of Boston. They've created an entire city. When they go down, it's going to be there are a lot of jobs that are going to be lost. And I'm suspicious of this move in the iShares of the Nasdaq Biotechnology ETF. But as of yet, I'm anticipating that there's a move in the IBB above 302.98. I think there should be. I don't know if there will be. That was B, and there should be a C and a D. But it's also saying to me they are becoming extremely overextended based on the monthly chart, and that if there's a correction, we might see those guys start to pull back, whereas the financials are still steadily walking the 9-period moving average. Only just the last few months has the XLF gone above and crossed over positively the 200-period exponential moving average after being decimated when it broke down from the February of 2008, around about 29-25 level, going all the way down to 5.88. This is, again, a very steady move to the upside. The next real serious resistance will be somewhere around 28.17, which is a peak that was made on one of those bounces that failed, the dreaded H pattern that goes back to May of 2008. So the answer to the question is, as long as that rotational aspect, which it made itself obvious the first summer of 2009, it was already 2010, that summer, I'd say, well, now we've got something that we've got to look for as a pattern that might unfold, in that the market might just make sideways rotational corrections as some sectors get really taken apart and others come in to take their place. Or the really good sectors just take a decent breather while others have a little bit of a bounce, and then the leaders come right back again. That's what we've seen in the QQQ, because of Apple, not because of Apple solely, but kind of led by Apple. Apple today is at all-time highs at 113.05, making that same kind of extended move to the right. And now what would happen is if the IBB came down very sharply, but also took with it the high-techs, of which the XLK would be a member of the XLK is the S&P Select Technology Spider Fund, which is extending, but it hasn't really overextended, but it really looks like this is possibly more than a G. It is really looking like an A in the weekly chart. So that makes the next couple of weeks really important. And the irony is that the XLK in the daily chart is only in leg B. So to answer your question, I suspect that if any pullback is contained over the next 2 weeks or so, and then we start to break out again to the upside, those folks who are out the market, and especially the category middle-aged to older, who kind of got out the market, said, I'm done with the market, you won't catch me in this baby again, will go into the market for that accelerated vertical projection to the upside that is a possibility in 2015. So I hope I'm kind of giving you a picture of what I'm looking at here. That's Dan.
I'm sorry, Basil.
Okay.
Yes.
So, yeah.
Just a quick question: could that distribution be more of a sideways consolidation? Distribution from the institutional funds versus an upside spike?
Oh. So you're saying, is there a possibility that we are kind of making some kind of a top here, and that there could be residual highs, but not very much higher, because distribution says that there's money coming out, more money coming out than going in, and that would be more institutionally oriented. Is that kind of your question?
Yes, sir. Okay.
Absolutely, I have to consider that. But at the same time, the way the market came down, 8%, 9%, in September, from September 19th to October the 15th. And the way the VIX index it's as if everybody that was nervous just sold their stocks, because it spiked to 3106. It's one of the biggest moves to the upside in the VIX index, and the sharpest move to the downside, when in fact the market only pulled back 9%. There was no 20%. If I was looking at the volatility index and I knew nothing about the market, but I really knew about the volatility index, and you said to me, hey mister, the volatility index went from the 10-11 area to 31.06. What do you think the market pulled back to? I would have said easy 15 to 18, maybe 22%. That would be my thinking. So that is in essence saying that the fear factor comes in and is so intense that you usurp that downside energy very quickly, and that allows for the market to heal itself in a very orderly way and then come back even stronger. But I'm starting to do a little work which I hope to present to my subscribers. I don't know if I'm going to have time, but hopefully it'll be within the next, by Thanksgiving. And that's going to talk about the relationship of speed of corrections and depth of corrections as you're moving higher to an extremely overbought situation. So that's going to be time and price of fear. That's basically how I can put it. And I've got all the ideas. I've started working on it, but to actually put it together as a thesis, it's going to take a little while. Coherent. Sometimes I have these things at the back of my mind. It's a complete picture. It is totally done. I have it in my mind as the end result. But to then formulate a whole program that confirms that empirically and in every other way can take a little bit of time. So I'm going to have to, I'll have to try to see how I can do that. But in the meantime, back at the ranch, I can make it real easy. A close in the Dow below 17,000 in the next couple of weeks would be a hint to say that this particular move is going to take more time and price to the downside before it starts the next big move upside. A close into the 17,800, 17,900, especially 18,000 area in the next 3 to 4 weeks says we're going into the acceleration phase. Start to look for the industrials to represent what happened in the NASDAQ and the semiconductors and the high-tech stocks of March of 2000, going from November, December of 1999 into March of 2000. So that's all I can say. And a lot of it will be based on the VIX. I'll make it real easy. Dow under 17,000, at least 2 out of 3 weeks, very negative. VIX holding in the 19s, very positive for the VIX, very bad for the market. And that's about, easier than that, I don't know if I can do it.
Super. Basil, thank you so much.
Thank you. And, I will be talking about the relationship of this particular move, especially in the Qs, which has a D/A potential in the weekly chart. And the way the weekly charts start to move going into this coming Friday, not this Friday, not tomorrow, but a week from tomorrow, should be telling me quite a bit about what I can anticipate going into the end of the year. But I'm just going to make it real clear. In the market itself, generally, when you've passed the September-October lows that inevitably occur and you're moving higher, you tend to move towards the highs of the market into the last week of December. So we'll see if that holds true. Hey, thanks so much for calling and giving me an opportunity to talk about that. Dan in Baskin Ridge, New Jersey. Now let's do something else. I wanted to talk about this because there's a relationship. Well, first of all, in the Den, Fletcher mentioned Russia, and I just wanted to do a quick RSX, I think it was. Yeah, RSX is the Russian market. Now, inevitably, at the turn of a century, going into the first decade and just coming out of the first decade, you have to be aware that things that you get your Napoleons and your Hitlers, etc., right at the turn of the century, Well, I'm watching Russia. I'm watching this guy Putin, because there's a very good chance that the market is saying that whatever Putin is doing is just not great for the Russian stock market. It's making yearly lows right as we speak. But this is based on the Market Vectors Russia Index, the ETF. I do not have the actual Russia Index itself, and sometimes there's a discrepancy. So I'm just basing it on this alone. And what I'm saying is that you've got to watch these people that come to the fore politically and then start to move things around like it was a chessboard. Like people are not people. They are just merely implements to be jostled with, etc. I do not like that. I do not like to see it. And we've got to watch this guy. We've got to watch him real closely. Most importantly, if this all the aspects of what made Russia succeed for a little while, how they embraced a form of capitalism, but as someone once said, and I thought this is really appropriate because it was something that I hadn't really thought of in that context, and he had said about 3 years ago that Russia at this particular time, that was 3 years ago, is a little bit like the mafia during the 1929, 1930s. They could pretty much do anything they wanted. They had free reign, and they were going to use it as much as possible. I thought to myself, gee, that's put into that context, I think he had a point. So we've got to watch this really closely. So that based on the RSX, this is something to watch. And I think that you've got, in 1929, General Motors bought a German, I believe it was an airplane engine company. When people say, as they have said for a long time, that never before have markets been so interrelated, that's not true. At all major market tops, they're all interrelated. So I'd be watching this really closely. All right, enough with that. I wanted to move on. I've spoken about, I'm just going to do it one more time. Look, here's the wheat's gone even higher since we last spoke. Wheat is already breaking out. Here's the corn, looking really strong. I wanted to go back just for a moment to the natural gas, just to review. Natural gas is now pulling back even further. And what I had said to our caller earlier on is that if you want to do a little nibbling here, okay. But the real effort would be if UNG, which is the United States Natural Gas Fund, got to the 200-period moving average in the 120-minute chart, somewhere around 21.04, 21.10, let's say, to 20.98, somewhere around there. That's really going to be the benchmark. If that 200-period moving average is pierced and it starts to close under, that's not a good sign. This is a very important moment where UNG, natural gas, based on the weather, should be doing very well. And the same thing with coal stocks. I went to the coal stocks and I've discussed it. Coal's holding much better. But if you want to look politically, obviously, natural gas has a little bit more, possibly maybe a little more leeway than coal. I'm not sure about that. But let's look at the crude oil, CL. Now, CL is breaking down. And what I had said is I see nothing as support in crude oil, based on my methodology, until crude oil retests the left side low bar, going all the way back to, good grief, going all the way back to two places. June of 2012 at 74.06 and July of 2011 at 74.30. We'll talk about that when I get back. Basil Chapman sitting for Larry Pesavento in the Futures Hour.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. When you first learn something in life, you have the most questions as you begin to apply that knowledge, which is why Steve Rhodes came up with the idea for his 7-week trading program. It all begins Saturday, November 22nd, when Steve Rhodes will host a live 3-hour morning workshop where he'll teach his attendees the precise methodology he uses when placing trades. You'll then receive 6 weekly updates each Monday morning discussing the possible alerts currently setting up in the market. Steve will then bring everyone back together for a final 3-hour live workshop Friday, January 9th, where he'll discuss the methodology that went into each of the 6 weekly updates, making sure that you're confident in applying what you've learned so that you can begin navigating the market on your own. You can sign up right now for this entire 7-week trading program with Steve Rhodes for a one-time payment of only $395. If you're a Mastering Probability subscriber, then you can save an extra $100 off that price. For all the details, visit the front page of TFNN.com right now.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Hi, folks. We're back, and we are back with Michael in Toronto. Michael, how are you?
Hi. Thanks for taking my call.
My pleasure.
It's perfect timing. I want you to take a look at the DTO.
And the reason you want to look at the DTO is because it's the Power Shares DB crude oil double short, and it's in leg D in the daily. Correct?
Correct, Mundo. Can you give me some upside targets? Because I know you're running out of time.
Okay. Oh, I am running out of time. Yeah, A, B, C, D, E. Okay, leg E in the weekly chart, leg D in the daily chart, only leg A in the monthly, and it's just above the 200-period moving average. We are about to get into some kind of resistance, and that's the reason if I look at the U.S. Oh, are you long?
Yeah, I'm long, yeah.
Okay, I'm going to make this 2 suggestions. One is we are real close to that test that I was talking about in the crude oil of the left side low bar that goes all the way back. There should be maybe a little bit more to the downside, but the bar that takes out the left side, most important left side low, is the very bar or the very next bar. It has to come right back. It must make a little V-shaped pattern to come back above. So I'm suspecting that there's a little bit of a bounce coming in crude oil in the next day or two, which maybe will correspond to the XAL XAL, brand new leg, and the weekly. Oh, boy. That's the airline index. Let me just see. The daily is at B1, made a C. Yep. We are really close to some kind of a pullback. So here's what I'm thinking. DTO, do you have enough that you could take a little bit off right now?
I've got this funny feeling we're heading substantially lower.
Lower in oil?
Yeah. Just a one-to-one move. You notice how the crude oil sat around 84 for weeks on end? And you look at what was the high in the summertime? Was it 104 or 107?
105 or something like that, yeah.
Yeah, so it's a one-to-one move. Once they broke to 84, you subtract 20, what do you get? 64.
Okay, I don't disagree. We're talking about timing, and you have no time worries here because other than shrinkage, because it gets recalculated, if you're in the right trend, you're going to do okay. All I was going to suggest is that within this area between 49 and maybe 50 to 50.20, I would consider taking a little bit off for two reasons. One is it's been a spectacular move in the weekly chart. This is about the period where it should start to have at least a week or two of a sideways movement, just on a visual basis. But the weekly technicals are really strong. I agree with you. So this is the short side.
Can you toss me a projection? Do you see a gap between 58 and 60 on the DTO?
I tell you what my projection would be, is that if in the next 3 weeks the DTO does not break, it's at 49, if it does not close underneath the 45 to 44 support area, but instead is juggling with just slightly higher highs, and that's how it consolidates within a rectangle formation, the next move up would take it to between 52.01 and, I don't want to say 61.11. That is huge, but I know where it is. 55. That would be about the point where I start to look at it and say something here is really happening that is different to other times. But in the meantime, I still would say to you, the support is at 42.17 on the weekly chart of the 9-period moving average. The 9-period is very close to crossing over the 200-period moving average. Those are different crosses. People call them different time levels. I happen to say when it does cross, it usually is really close to some kind of a reversal, whereas some people think it's a confirmation of a breakout or a breakdown. I look at it as a warning to say we're getting close to some kind of a pullback. So that's why I'm saying I would recommend thinking, you know what, a nice way to do it is, you let the market tell you, and I would put a stop on just a little portion to reward yourself and to have money left over so that you can put it back in on a pullback, make it 47.50, some kind of take a little bit off. I'll talk about it next week. That's when I think we get the turn. Hey, thanks for calling, Michael. Folks, stay tuned. You've got Daryl Martin coming up. I'll be back on Monday.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.